Welcome to The Explainer. We're all about taking complex trading ideas and turning them into real actionable insights you can actually use.
You know that feeling, right? You're staring at a chart and the price isn't really going up, it's not really going down, it just feels stuck. It's moving sideways. Well, that period of indecision is exactly what we're going to tackle today. Now, it might look like random noise, but inside that sideways chop, the market is actually telling a story. It's painting a picture of a battle between buyers and sellers. And today, we're going to learn how to read those clues that the battle leaves behind. We're going to zoom in on two really powerful chart patterns that pop up when a trend is just taking a breather, the ascending and the descending triangles. Now, at first glance, they look pretty similar, but trust me, they tell two completely different stories about who's winning this fight. So on one side, you have the ascending triangle. That's your bullish signal. It's whispering that the price is coiling up for a move higher. And then you have its opposite, the descending triangle. That's the bearish one, hinting that the floor might be about to fall out.
All right, let's kick things off with the ascending triangle. So how do you spot one? You're looking for two things. First, a flat horizontal line up top. That's resistance. The price keeps hitting this ceiling and getting rejected. But below it, you've got a rising support line that connects a series of higher lows. And what's really cool is the psychology this whole thing reveals.
Think about what this means. You've got sellers who are holding the line at a very specific price. They won't budge. But the buyers, they're getting more and more confident. Every time the price dips, they're jumping in sooner at a higher price than the last time. That growing pressure from the buyers is basically squeezing the price right up against that ceiling of sellers.
And this table just lays it all out. That flat resistance line, that's the seller's wall. The rising support line, that shows the buyers are gaining ground, they have the momentum. But here's the secret ingredient, volume. You'll often see volume kind of dry up as the pattern gets tighter. But then, when the price finally breaks out, you want to see a huge spike in volume. That's the market basically screaming, okay, this move is for real.
Okay, now let's flip the script and talk about the descending triangle. It's pretty much the mirror image. This time, you've got a flat support line at the bottom where buyers are trying to hold their ground. But above it, you've got a falling resistance line, connecting a series of lower highs.
So what's the story here? Well, the sellers are clearly taking control. They're getting more aggressive, willing to accept lower and lower prices every time the market tries to rally. All that downward pressure is building up against that floor of buyers, and, eventually, that floor is probably going to crack.
Okay, so this is all great, but what do you do with it? You've identified one of these patterns on your chart. How do you actually trade it? Well, let's get into a really practical three-step playbook. It really comes down to these three things. Step one is your entry. And the key here is patience. Don't jump the gun. You want to wait for a nice, strong candle to close outside the pattern. Step two, your stop loss. This is non-negotiable. It's your safety net. You place it just back inside the pattern to protect yourself if the breakout fails. And finally, step three, your profit target. A super common way to set this is to measure the widest part of the triangle and just project that distance from where it broke out. Okay, now look at this on a real chart. It makes so much more sense, right? You can see that ascending triangle forming, clear as day. Then boom, there's your strong breakout candle signaling the entry. Your stop loss is tucked safely below that rising support line, and the profit target is projected up. Seeing it like this just makes the whole theory click. But now we have to have a little reality check. If you're looking for foolproof, 100% guaranteed patterns in trading, well, they don't exist. Even the most beautiful, textbook-perfect setups can and absolutely do fail. And honestly, understanding why they fail is just as crucial as knowing how to trade them when they work. Being prepared for failure is a huge part of what separates the pros from everyone else. So you see this perfect triangle, the price starts to poke out, you get excited, you jump in, and then, it slams right back down, trapping you. So what in the world is going on there? Well, there are a few usual suspects. The big one is a breakout on weak volume. That's a massive red flag. It shows there's no real conviction behind the move. Then you've got things you can't control, like a sudden shift in the whole market's mood or a surprise news event. Or sometimes the market's just tired. If an asset has been rallying for ages, the buyers might just be exhausted. And all of this leads to what we call the false breakout. It's one of the most frustrating things in trading. The price teases a move, sucks you in, and then snaps back in the other direction. It's a common trap, but the good news is you can learn to sidestep it more often than not. So, how do we trade smarter and avoid getting caught in those traps? The whole game is about adding layers of confirmation. You want to be a detective looking for multiple clues before you pull the trigger. So here's your checklist. First, demand to see that big spike in volume. Second, wait for a strong, full-bodied candle to close decisively outside the pattern, not just a little wick. Third, see if other indicators agree. Is the RSI, for example, showing momentum building in your direction? And finally, this is a real pro move. Wait for the retest. Let the price break out, then come back down to test that old boundary. Entering there can give you a much better entry and help you dodge a false move. And you've got to remember, trading is a game of probabilities. It's not about being certain. Even a super reliable pattern like the ascending triangle has a historical success rate somewhere between 64 and 77%. It's a statistical edge, not a crystal ball.
Oh, and the time frame you're trading on, it makes a huge difference. Patterns you find on longer time frames, like a daily or a 4-hour chart, are generally way more reliable. You can use the shorter time frames to really dial in your entry for sure, but the big picture on the higher time frame usually tells the more trustworthy story.
But, at the end of the day, it all comes down to what's going on between your ears. It's about psychology, having the patience to wait for that perfect A-plus setup, and the discipline to actually follow your rules. That is what really makes the difference.
So the next time you see one of these triangles forming on a chart, ask yourself this one question. Am I reading the story the market is actually telling me with price and volume, or am I just seeing the story that I want to see? Being honest about that could be the key to everything.